So, we are starting our webinar series on SL1. So, we are discussing the very latest past paper, the SL1 paper of the exam that was held in February 2021. I will not discuss the entire paper as per the requirements of the institute. I will be discussing only the question number 3 console part. Now, as you all know very well, for us to complete the question number 3, in addition to the contents in the unseen paper which is given at the exam hall, also you need to look at the contents of the pre-seen. Now, before you start watching the video, I will recommend all of you all to go through the pre-seen content and then to start attempting question number 3, console part. And this carries this carries altogether 22 marks. So, this is a sizable amount of marks in the paper, and as per the comments of the examiner, the performances of the students seems to have been very poor. So, I want all of you all to pay your prime attention to this part, the console part, and to make sure that you will score the maximum from the console part. I hope these discussions will be of an immense use for you to score at the exam in your paper in coming July. So, we will get on with question number 3. When introducing its own brand to the international market, Healthcare and Leisure Private Limited carried out a careful analysis of new market potentials. This resulted in HCL identifying an opportunity to further invest in Healthcare Drugs Bangladesh Limited, that is HCDBD. HCDBD has already entered the Indian market by acquiring a 70% holding in Pharma India Limited. Therefore, further investment in HCD opens the door for HCL to expand in the Indian market. The following information is provided. HCL is planning to buy a further 45% of HCD Bangladesh, increasing HCL's total holding to 80%. To acquire this 45%, HCL will be required to pay 1,750 million rupees. In other words, it has to be 1.7 billion in cash immediately and issue one ordinary share of HCL for every 5 shares acquired. Further, HCL will be required to pay 20 million rupees in 2 years if HCDBD achieves a year-on-year net profit growth of 3%. From the current level, during the next 2 years, there is a 40% probability that HCL has to pay this amount in full, a 30% probability that 60% of this amount will have to be paid, and a 30% probability that nothing will have to be paid. Professional costs of 50 million rupees relating to the acquisition are included in the cash consideration. Market values per share of HCL and HCDBD on the date of acquisitions are 50 rupees and 10 rupees respectively. HCL will borrow from financial institutions to source the amount required for cash payment of 1,750 million rupees on the date of acquisitions. The fair value of the existing holding of 35% in HCD is rupees 998 million. The group's policy is to measure non-controlling interest at its proportionate share of the fair value of subsidiaries' net assets. The following information relates to the assets and liabilities of HCD as at 31st March 2020. Land classified as property, plant and equipment has been revalued, resulting in an increase in the value of land by rupees 200 million. However, this value has not been incorporated in the amounts of the company. At the point of selling, this type of property is subject to capital gains tax at 30% in Bangladesh. HCD BD has disclosed in its financial statements a contingent liability with a reliably estimated value of 12 million rupees. HCD BD has not made a provision since the payment is not considered probable. Discount rate of 10% should be used for any calculation required. The statement of financial positions of the Indian subsidiary of HCD BD as at 31st March 2020 is given below. Assets, non-current assets, property, plant and equipment, intangible assets, current assets, inventory, trade and other receivables, cash and cash equivalent, stated capital, foreign exchange reserve, retained earnings, deferred tax liability, employee benefit liability, trade and other payables, income tax liability. Assuming that the date of acquisition of the additional 45% holding in HCDBD is 31st March 2020, prepare the consolidated statement of financial positions of HCL as at 31st March 2020, incorporating the result of the above acquisitions together with detailed calculations required. This question looks very straightforward compared to the other questions in the previous past papers. I wonder why the performances were poor, because scoring 22 marks for this question is not so hard. And let us look at the group structure first and foremost. Now, to identify the group structure, you also need to go through the pre-seen content. Since I have gone through, I can remember the facts, but you need to go through that first and then only you need to attempt the question. Now, original parent company was HCL. HCL, and if you just go to page number, I'm referring to the pre-seen case study. If you go to page number 6, it says HCL acquired 35% of equity shares in this Bangladesh company on so the acquisition has occurred during the current year in December, just few months ahead of the reporting date. Then the unseen paper says HCL had acquired another 45% right on the reporting date, that is 31st March 2021. It is 31st March 2020. So, the cumulative equity holding by HCL in Bangladesh company is for 80% now. Cumulative equity holding in Bangladesh company is 80%. Now, even before that, Bangladesh company had another subsidiary company which is an Indian company, and Bangladesh company had 70% equity holding in this Indian company. So, this is the group structure, a simple group structure. On one hand, this seems to be like a complex group. So, there are how many companies? I mean, there are two subsidiary companies, subsidiary company 1, this is Bangladesh company, Indian company has to be the subsidiary company. And then, especially if you talk about Bangladesh company, parent company HCL has established their controlling stake, controlling power in this Bangladesh company in a successive share purchase transactions. Initially, they have acquired 35%. So, obviously, that would have been accounted as an associate company using equity method. On top of that, they continued or they acquired another 45%. So, with that 45% only, this Bangladesh company becomes a subsidiary company where parent company HCL can start controlling, can start exercising the control in Bangladesh company. So, this is how it is. So, you need to perform two calculations, two goodwill calculations for Bangladesh company and for Indian company, and before you start doing the calculations, identifying the group structure will be absolutely important. That is what we did now, and we can get on with the calculations. And be careful, sometimes you will do mistakes in the calculations. The way the figures are given, sometimes little misleading. So, you need to be careful. I mean, it is not wrong, but the way it is presented, I mean, you will get into a confusion as you extract figures from the questions to the answers. So, be careful in doing the questions, and let us see. We will write up the balance sheet format first. Remember, as you prepare the balance sheet format, you need to stick to the parent company's balance sheet format. So, let us take the pre-scene, that is where the parent company's balance sheet is given. So, those are the line items to be included in the balance sheet. Say HCL Group consolidated statement of financial position as at 31st March 2020, say assets and then say non-current assets, non-current assets. Say property, plant and equipment, let me use the abbreviations because I need to have space. Investment properties, investment properties, leasehold right, leasehold right, intangible assets. Before that, let us take the goodwill. Property, plant and equipment and goodwill, investment properties, leasehold right, intangible assets, intangible assets, other non-current assets, other non-current assets. current assets, under that inventory, trade and other receivables, tax recoverable, other current financial assets, cash and short term deposits, we will take the total assets, stated capital, consolidated reserves, non-controlling interest, non-current liabilities, interest bearing loans and borrowings, other financial liabilities, deferred tax liabilities, employee benefit liabilities, now HCL acquired 35% in Bangladesh company in December 2019. So, from the date of acquisitions of 35% right up to the balance sheet date, Bangladesh company would have been an associate company, and that is the assumptions we can reasonably conclude to in the absence of informations to the contrary given. Now, parent company's balance sheet includes investment amount of 984,500 in the balance sheet of the parent company as at 31st March 2020. 984,500 investment figure has not been explained, described in the question. I feel that is a bit of a weakness in the questions that would have been explained. If not, we have to make assumptions. Sometimes either you can assume that parent company or rather HCL company did not apply equity method of accounting and they have just recognized it under financial instruments. What makes me think so is because the given financial statements are unaudited. But if it was audited accounts, obviously we need to arrive at the conclusions that they would have acquired 35% right from day one of the acquisition right up to the balance sheet date. Then we can reasonably conclude that they would have applied equity method of accounting to recognize the investment in the balance sheet. So, that particular fact or the piece of information is missing in the questions. I feel that would have been bit of a ambiguity for the students at the exam, they can either assume that this is at cost or this is at fair value and SLFR is 9, or this is under equity method. So, various students would have made various assumptions in arriving at the final figures. So, I will reasonably assume that depends on the assumptions you make. I will reasonably assume, even though despite of the fact that given financial statements are unaudited financial statements, investor HCL would have recognized the investment under equity method of accounting from the acquisition date right up to the reporting date of 31st March 2020. I will make that reasonable assumption. Then to complete the goodwill, let us get on with the goodwill calculations. I will open up cost of control account for Bangladesh company, and let me derecognize investment in the associate company under equity method and to recognize it as the investment in the subsidiary company. How much? 984,500. Investment 984,500. 984,500. Then we will go to the informations given in the unseen in your paper. Let me start with point number 1. HCL is planning to buy a further 45% of HCDBD, increasing HCL's total holding to 80%. To acquire this 45%, HCL will be required to pay 1,750,000,000 rupees, 1,750 million rupees in cash immediately. Cash consideration, let me bring it here. Let us show the figures in 1000 as the figures in the given financial statements are also in 1000. 1 million or 1,750,000,000 rupees will bring it to the cost of control as part of the consideration transfer to acquire 45%. So, how has the parent company financed? How has the parent company financed this amount? And they have gone for a bank facility. So, obviously, there has to be a bank loan, and let me include it into non-current liabilities of the parent company. We will say 1 million or 1,750,000,000 rupees. We will bring it to the balance sheet before we forget it. If not, you will be mistaken and will forget it to bring it to the balance sheet. We will complete all the double entries here and then and there, just to make sure that we will maintain the accuracy. So, we will bring it to the cost of control as it is a part of the consideration transferred. Also, it has to be part of the non-current liabilities of the parent company, that is HCL. Will include that into interest bearing loans and borrowings, 1,750,000,000 rupees, and issue 1 ordinary share of HCL for every 5 shares acquired. Right. There is a non-cash consideration as well. Non-cash consideration. So, non-cash considerations need to be measured at its fair value. Before everything else, we will work out on the number of shares issued. This Bangladesh company, if you see the balance sheet of Bangladesh company, they have a share capital of how much? Bangladesh company has a share capital of 750,000 in their local currency, TK currency, and somewhere in the pre-scene they had said that the value of a share issued by Bangladesh company has been 10 TK currency. Let me see where it is. If you go to page number 9, it is given company HCDBD ordinary shares issued at TK 10 per share. So, for me to calculate the number of shares in issue, so what I will do is this 750,000 will be divided by 10. Number of shares will be 75,000. Now, you need to focus and concentrate only on the current acquisition of 45%, not the previous. And out of this 75,000, HCL is now purchasing 45%. So, let me work out 45% out of 75,000. 75,000 into 45% should be 33,750. 33,750. Now, HCL being the parent company is going to issue 1 share for every 5 shares acquired in Bangladesh company. That is what it says in the question. It says, and issue 1 ordinary share of HCL for every 5 shares acquired. Will divide it by 5 and multiply it by 1. 33,750 divided by 5 into 1. The number of shares issued by the parent company should be 6,750. And this has to be multiplied by the fair value to measure it at fair value. We are given the values of shares of both companies on the acquisition. Let us see what it is. It is given in the question unseen. Second adjustment, market values per share of HCL and HCD on the date of acquisition are 50 rupees and 10 rupees. This has to be multiplied by 50. 6,750 into 50 should be 337,500. Let me include it to the consideration transfer, 337,500. Share issue, shares, and let me add it to the parent company share capital, 337,500. 337,500. So, the paragraph number or point 1 of the adjustments continues to say that HCL will be required to pay 20 million rupees in 2 years' time if HCD Bangladesh achieves a year-on-year net profit growth of 3% from the current level during the next 2 years. There is a 40% probability that HCL has to pay this amount in full, a 30% probability that 60% of this amount will have to be paid, and a 30% probability that nothing will have to be paid. Professional costs of 50 million relating to the acquisitions are included in the cash consideration. Now, let me first concentrate on this 50,000 professional fees. 1,750,000 has been paid not only to acquire equity shares, but also it is including 50,000 rupees professional fees. And let us look at the accounting prescriptions for acquisition cost in SLFRS 3. SLFRS 3 says, if you have incurred professional fees, acquisition cost, share valuation cost on acquisition, that particular cost cannot be included in the investment taken for the goodwill calculation. That has to be recognized as an expenditure of the parent company as incurred. So, that accounting made by the parent company does not seem to be accurate, and it does not fall in line with the requirements of SLFRS 3. To rectify that, I need to take it off from the consideration. I will credit to cost of control account by 50,000, say professional fees, and let me debit it to the parent company's profit and loss. Parent company's profit and loss, consolidated retained earnings. consolidated retained earnings. Let me take the parent company's retained earnings figure. They have given us the reserve 6,770,578 and will debit it to consolidated retained earnings by 50,000, say professional fees. Professional fees 50,000. Then this contingent considerations, it's little different. The way it was given in the question looked little different the way we used to in the classes, but anyway it's a good adjustment. Let's see how it is done. So there is a HCL will be required to pay 20 million in 2 years if Bangladesh company achieves a year-on-year net profit growth of 3% from the current level during the next 2 years. So there is a 40% probability that HCL has to pay this amount in full, a 30% probability that 60% of this amount will have to be paid, and a 30% probability that nothing will have to be paid. Right. 20 million is a consideration to be transferred not immediately in 2 years' time, subject to the profitability, level of profitability in the acquiree, and it says there is a 40% probability that HCL has to pay this amount in full. 40% probability, this has to be multiplied by 40 into 100%. 40% probability that total amount has to be paid. So we will take the expected value based on the probabilities given. You know, as you calculate the fair value of the contingent considerations, also you need to include any uncertainties attached to the payment. So that is what we are going to do now. So there is a 40% probability that the full amount will have to be paid, and a 30% probability that 60% of this amount will have to be paid. 20 million into 30% into 60%, and a 30% probability that nothing will have to be paid. 20,000 into 30% probability into 0%, nothing will have to be paid. So let us work out on the expected value first before you calculate the present value. 20,000 into 40 into 100% should be 8,000. 20,000 into 30% into 60%, 3,600, and this one has to be 0. So expected value of the contingent consideration should be 11,600, and to calculate the fair value you need to convert it to the present value. So we are given the discounting factor, discounting rate has to be 10%. 11,600 should be discounted by 1.1 to the power 2. That becomes payable in 2 years' time depending on the profitability of the subsidiary company. So let us take the fair value. Fair value has to be equal to the present value. 11,600 divided by 1.1 to the power 2. 9,586. 9,586. Let me include it to the consideration. 9,005. Let me make it 87. 87. Say contingent consideration. Contingent consideration. Contingent considerations has to be 9,586. 87. So, let us continue. Number 2 was taken into account. Number 3, HCL will borrow from a financial institutions to source this amount required for cash payment of 1,750 million rupees on the date of acquisition. That was taken into account. The fair value of the existing holding of 35% in HCD is rupees 998 million. The group's policy is to measure non-controlling interest at its proportionate share of the fair values of the subsidiaries' net assets. Now, the investment in the associate company, so before they established the controlling power, it was an associate company, and the investment was stated at 984,500. What do we reasonably assume? The previous 35% equity holding is assumed to have been sold on the acquisition date, and the entire 80% is assumed to have been acquired on the acquisition date, which is 31st March 2020. Now, if you assume that this original 35% was sold, you need to work out on the disposal profit. So, without doing, I am just telling you without teaching that part, and that takes long time to get back to theory and to explain that from the beginning. So, without doing this disposal exercise, what we simply do is, the difference between the carrying value of the existing stake of 35% and its fair value should be adjusted to the considerations while it being recognized into the profit of the parent company. So, the difference is how much? Existing carrying value is 984,005 and its fair value has been how much? 998,000. This is 984,500. So, the difference is how much? 0, 0, this is 5, this is 3, 13,500 should be the fair value change. And let me debit it to cost of control account, 13,500, say fair value change, and will credit it to consolidated retained earnings, 13,500, fair value change of the existing stake of 35% rather, fair value change of the existing stake of 35%, 13,500, will credit that to consolidated retained earnings. Fine. Then NCI has to be based on the proportionate book values of the net assets attributable to NCI. So, let me complete that part after working out, after incorporating the required adjustments arising out of the due diligence. Number 5, the following information relates to the assets and liabilities of HCD as at 31st March 2020. Land classified as property, plant and equipment has been revalued, resulting in an increase in the value of land by rupees 200 million. That 200 million should be adjusted to property, plant and equipment. Let us do it here and we will credit that to the reserve, and the reserve is taken to cost of control account as it has to be part of the net assets value. Revaluation on property, plant and equipment. It says, however, this value has not been incorporated in the accounts of the company at the point of selling. This type of property is subject to capital gains tax at 30% in Bangladesh. Now, the examiner, without sometimes giving all the informations explicitly, will try to beat about the bush to give it implicitly. So, what does it say? What does the examiner try to make you understand from this last sentence of this paragraph? As you sell this property in the future, as per the tax jurisdictions in Bangladesh, you are liable to pay 30% tax on this capital gain. So, the examiner is expecting you to calculate and to recognize the required deferred taxes on this revaluation. So, deferred tax on revaluation should be how much? Deferred tax on revaluation. Deferred tax on revaluation, 200,000 revaluation gain into 30% should be how much? Should be 60,000. And the deferred tax figure is deducted, deferred tax liability should be deducted from the net assets on the acquisition date. So, let me debit it to cost of control, and to bring it to deferred tax liability will be added by 60,000, added by 60,000. Then Roman simple number 2, HCD Bangladesh has disclosed in its financial statements a contingent liability with a reliably estimated value of 12 million rupees. HCD has not made a provision since the payment is not considered probable. This contingent liability has been reliably estimated to be 12 million rupees. So, this seems to be like a probable contingency, and you need to recognize that into the books of the group on the acquisition date. So, what I can do is deduct it from the net assets value on the acquisition date. Instead, I will debit it to cost of control account, say contingent liability, and let me put it under non-current liabilities in the balance sheet, contingent liability. Contingent liability should be 12,000, should be 12,000. We will complete the non-controlling shareholders calculations now, and before that let me bring the net assets value of HCD on the acquisition date that you can extract from the precede. The balance sheet given on 31st March 2020 for Bangladesh company says total equity on 31st March 2020 is 3,571,824. Net assets of the subsidiary company 3,571,824. We will work out on non-controlling interest. Subsidiary company's net assets 3,571,824. But this is not the value on which NCI percentage applies to calculate the value of NCIY. This book value of net assets of the subsidiary company was revised, and that was modified by incorporating a lot of adjustments. Let us see what those are. There was a revaluation, and this revaluation gain has to be added. Revaluation gain is 200,000. And there was a contingent liability, and that has to be deducted. Contingent liability of 12,000, this has to be deducted. Also, there was a deferred tax liability arising out of the revaluation of the property, even that has to be deducted, minus deferred tax. Deferred tax liability 60,000, so that is it, and let us arrive at the value of net assets on the acquisition date of Bangladesh company, and that is that value on which you should apply 20% NCI percentage to arrive at the value of NCI on the acquisition date. So, let me complete that 3,571,824 plus 200,000 minus 12,000 minus 60,000, that is 3,699,824 into 20%. This is 739,965, 739,965. So, we can complete the goodwill calculations. Let me have a small quick look to make sure that everything that is required to be taken has been taken now. 984 was okay, 1,750,000 taken, 337,500 taken, 9587 was taken contingent considerations, then fair value change was taken 13,005, 60,000 was taken, 12,000 was taken, and NCI figure, NCI 739,965, 739,965, and let us take the goodwill now. We will close up the account and see what the goodwill has to be. 984,500 plus 1,750,000, 337,005, 9,587 plus 13,500 plus 60,000 plus 12,000 plus 739,965, 3,907,052, 3,907,052 minus 50,000 minus 200,000 minus 3,571,824. So, the goodwill has to be 85,228, goodwill has to be 85,228, and let me bring it to the balance sheet. 85,228, goodwill has to be 85,228, and this seems to be like the bread and butter in the questions. If you complete this part out of 22, already you have scored about 15 marks. And I'm still wondering why the performances were lower for these questions. Why it is such an easy question. It's only just that the information scattered all over the questions. Part of the information is in the pre-seen and part of the information is in the unseen. Just a matter of you being familiarize yourself with the unseen and the pre-seen, and just to see, to locate the information and then to bring it to a single paper like this. That's it. So, 22 marks is just nothing. You can simply easily score 22 marks. I wish this time also we will get a question like this so that you can score easily. Now, we are moving on to the next part of the calculations, that is the goodwill calculations for Indian company. So, let me open up another account, cost of control for Indian company, and also let me open up non-controlling shareholders account, non-controlling interest, and already I need to bring the Bangladesh subsidiary company's NCI figure 739,965, 739,965 cost of control of Indian company, right. Now, this Indian company becomes a subsidiary company through the Bangladesh company. So, it is the Bangladesh company who made the investment, who had made the investment in Indian company sometimes before. Even before the parent company HCL acquired Bangladesh company had already acquired the Indian company. But then again, you acquire the simultaneous controlling stake, controlling power in the Indian company as well, right together with the acquisition of the Bangladesh company. Why? When you acquire Bangladesh company, you not only acquire Bangladesh company, also you acquire Indian company simultaneously. So, as a result, when you complete the goodwill calculation, you need to be extremely careful and make sure that you will not do any mistakes. Why? Now say parent company has acquired 80% in this Bangladesh company, and Bangladesh company has only 100,000 share capital. I am just taking the simplest possible example to illustrate the concept. Bangladesh company has the share capital of 100,000, to which parent company has invested 80%, and the balance 20% is from non-controlling shareholders of the Bangladesh company. That entire share capital of the Bangladesh company given by various shareholders has been exclusively exhausted to acquire share capital of the Indian company. In other words, what does it say? How did the Bangladesh company raise their finance to make investments in the Indian company? Partly from parent company HCL, partly from the non-controlling shareholders of the Bangladesh company. Here Bangladesh company has 100,000 share capital, which was exclusively exhausted to acquire Indian company. Then this 100,000 investment is from the share capital of the Bangladesh company. So, parent company contributed to 80% of the share capital. In other words, parent company has contributed to 80% of the investment which Bangladesh company made to acquire shares in the Indian company. So, if you prepare the balance sheet from the ultimate parent company's perspective, when you bring the investment to goodwill calculations, please make sure that you cannot bring the entire 100,000 investment. You have to bring only the investment which is attributable to the ultimate eventual parent company. So, out of this 100,000 investments in my illustration, you need to drop off 20%, and we will bring only 80% of the investment for the goodwill calculation. So, let us do it now. That is where you need to be careful. And other than that, there is nothing, everything seems to be very simple and straightforward. Bangladesh company has an investment in this Indian company, how much? Investment in subsidiary 55,878. Out of that 55,878, we will take only 80% now. Investment is 44,702, and the balance 20% should go to whom? That has to go to the non-controlling shareholders of Bangladesh company. So, let me work out 20% of investment. 55,878 into 20% should be 11,176 investment. 11,176 investment is debited to non-controlling shareholders, and let us take the net assets of Indian company on the acquisition date, that is given in the unseen. How much? Net assets 65,575. Net assets 65,575. Then let us take NCI, that is at the proportionate net assets of the Indian company on the acquisition date attributable to NCI. Once again, that is another area where you need to be careful, if not you will be mistaken in taking the figures. Now, ultimate parent company is HCL. It is the Bangladesh company which made the investment in the Indian company. Right. Bangladesh company had acquired 70% in the Indian company. Where did I take that figure? It was given in the precede. And the parent company had acquired 80% in the Bangladesh company. So, what seems to be the effective controlling, or I can't say the control, effective stake in the Indian company? It has to be 80% into 70, should be 56%. So, then parent company's ownership stake seems to be 56% in the Indian company, whereas the balance 44% should be attributable to NCI, and you need not to analyze that 44% into the Indian company's NCI and Bangladesh company's NCI. That detailed analysis will be important for the understanding, but at the exam that is not needed, and the examiner does not expect you to do it either. So, we will simply take 44% of net assets on the acquisition date to NCI, and then we can complete the goodwill. 65,575 into 44%. 65,575 into 44%. 28,853. 28,853. Debit to cost of control and credit to NCI. 28,853. Cost of control is debited and you credit to NCI. Let us close up cost of control account and take the goodwill. 28,853 plus 44,702, 73,555. 73,555 minus 65,575. So, the goodwill has to be 7,980, and let us bring it to the balance sheet. 7,980 goodwill. 7,980 should be the goodwill, right. Let us close up all the other accounts now. Even we can close up non-controlling interest account and we will arrive at the final figure. 739,965, 28,853, 768,818, 768,818 minus 11,176. So, the non-controlling figure has to be 757,642. Non-controlling interest 757,642. Then close up consolidated retained earnings and take the balance. $6,784,078, 6,784,078 minus 50,000. 6,734,078. We will bring it to the balance sheet. Consolidated reserve 6,734,078. So, let us take the remaining figures from the balances given. Property, plant and equipment, let me first take the figures from the Indian company. 180,450, Intangible assets 5300, inventories 98,300, trade and other receivables 70,100, cash and cash equivalent 20,400. Stated capital taken, foreign exchange reserves were taken, retained earnings were taken, deferred tax liability. Deferred tax liability 8,750. Employee benefit liability 141,800. 141,800. Trade and other payables current liabilities, under that trade and other payables, $151,675. Income tax liability $6,750. Then we will extract the figures of the parent company and Bangladesh company. So, let me first take the figures from Bangladesh company. Property, plant and equipment 3,418,297. Investment in subsidiary was taken, intangible assets 3,309, other non-current financial assets 121,198, 121,198. Inventories 3,691,059. Trade and other receivables 6,027,177. Other current financial assets 55,281. Cash and short term deposits cash, so we can add it to cash and cash equivalents, no problem. 2,713. Share capital taken, foreign exchange reserves were taken, that is for the goodwill calculations, reserves and retained earnings were taken. Interest bearing borrowings 800,875, 800,875. Other financial liabilities 554,862, 554,862. Deferred tax liabilities 156,785, 785. Employee benefits liabilities 26,583. 26,583. Trade and other payables 4,460. 4,460. 385. Income tax liabilities 271,797. Interest bearing loans and borrowings 1,899,358. Bank overdraft 1,632,443. Now let us take the figures from the parent company HCL. Property, plant and equipment 8,823,281. Investment properties 582,474. Leasehold rights, prepaid lease rentals 131,276. 131,276. I made a mistake. You know, correct. 131,276. Intangible assets 468,946. Other non-current financial assets 148,936. Inventories 5,200,949. Trade and other receivables 4,322,332. Tax recoverable 19,270. Other current financial assets 5,475. Cash and short term deposits 73,000. $631. So let me add this figure also here, 20,400. Share capital 5,960,450. Reserves were taken. Interest bearing borrowings 553,567. 553,567. Other financial liabilities 455,697. Deferred tax liabilities 560,875. 560,875. Employee benefit liabilities 345,252. Trade and other payables 3,699,450. Income tax liabilities 253,000, 253, 456. Interest bearing loans and borrowings 1,553,250. Bank OD 1,225,254. So you can take the totals. Let me put the balance sheet total. $34,380,211 should be the balance sheet total, and this is what 22 marks have been offered for. You are required to prepare the consolidated statement of financial positions of HCL as at 31st March 2020, incorporating the results of the above acquisitions together with the detailed calculations required. So we have provided all the detailed calculations required: goodwill of Bangladesh company, goodwill of Indian company, then the retained earnings of the group, non-controlling shareholders, and all the other sub items, each and every line items of the group. You can just put the totals, but the balance sheet total has to be 34,380,211 rather 34,380,211. So this is what I am supposed to do, not the entire paper. So I wish we will get the same kind of questions in your exam as well, so that you can easily score 22 marks, and all the very best for the exam. Thanks for watching our videos.